For more on what's happening in the markets right now, let's bring in Greg Davis. He's Chief Investment Officer at Vanguard. And Greg, thanks for being here today. We could use your help because there are so many things that are flashing here, so many sorts of warning signs. What would you tell investors to think right now? Does the inverted yield curve mean a recession is coming?
Well, thanks for having me on. First thing I think investors need to keep in perspective, ultimately, the volatility that we've seen recently is driven by a number of factors. Clearly, it's going to be the trade tensions. Clearly, it's going to be some of the slowdown we've seen from an economic standpoint globally. But then also the fact that, the Federal Reserve has disappointed the market in terms of what they've done from a interest rate cut standpoint. The market was expecting more, and they haven't been as aggressive as the market would have liked.
So what's an investor to do now? What's the next step? Because people are feeling a little more, bigger sense of unease.
Yes, so the big thing we always tell investors, look, they need to have more realistic expectations going forward of where they think U.S. equities are going to do. And our Vanguard capital markets model, we're expecting that U.S. equities are going to produce somewhere around a 4% annualized return over the next decade on a median basis. And we think
4%.
There's better opportunities internationally. 4%.
Why 4%?
And we think
I mean, most of the time, even mutual funds, or if you're a pension fund, you're looking at it and saying 7 or 8%. Why 4%?
4%, it comes from our Vanguard capital markets model, and it's driven by valuations where we are from a valuation perspective, also taking a look at where we are from an economic standpoint. We're towards the end of a cycle, and correlations that happen with the various macro factors. And ultimately, we think there's better opportunities for investors outside of the U.S. So our expectations for international equities are closer to 7% on an annualized basis. But for most investors, we're telling them, make sure that they've rebalanced their portfolios. Because if you look at a portfolio that's been, typically a 60-40 portfolio, given how strong equities have been over the last 5 years or so relative to bonds, you're going to be overweight by, call it 65 to 35 for that type of portfolio. So investors have skewed towards a riskier portfolio, and we would encourage them to continue to rebalance.
Let's talk about where you see those opportunities internationally. If 7% of all the rest of the globe outside of the United States, world's a big place, though. Where do you think the best opportunities are?
When you think about international, it's like we look at it from a diversified basis, so across the entire market, the entire external market there. So, looking at Europe, looking at Asia Pacific, you're looking at places where, PE ratios are, at 13 times or even lower than that compared to where we are in the U.S., where we're north of 17 times. So, again, from a valuation perspective, the rest of the world just seems a bit more attractive to us. Given what's being priced in at this point in time.
There's a reason the PE ratios are 13 times in places like Europe and Japan and other places where they haven't seen the same level of growth. You think that is going to change, that they'll see more growth in other places, or that the U.S. growth gets dragged down to match what we've seen internationally?
I think our base case is that you're going to start to see a slower growth profile for the U.S., where we think trend growth is somewhere around 1.7 to 1.8%. And we do acknowledge the fact that, Europe is slowing down, and we've seen a slowdown in Asia Pacific as well. But a lot of bad news is already being priced in those markets. And from our point of view, that the U.S. market, valuations still seem elevated, and there's still a lot of bad news that's potentially out there when it comes to, the things we talked about, whether or not it's trade tensions. We're talking about the Federal Reserve that hasn't been as aggressive as the market has been anticipating. And we also have this in the backdrop of, a world where, you have negative interest rates across over $15 trillion of debt out there. And we think that's ultimately going to have an impact as well.
The only thing I'd say to that is when you're looking at negative interest rates in such a huge portion, 25% of sovereign bonds around the globe right now, stocks look like a much more attractive place to put your money because at least you can get some return.
But you also have to think about what's driving those low interest rates around the globe. Clearly there's a lot of liquidity in the marketplace, but there's also a tremendous amount of concern around growth. And so, when you look at the U.S. equity markets, there's a lot of good news that's being priced in. And we think there's a significant amount of headwinds that are out there that should make investors a bit more cautious. And that's one of the key drivers that's ultimately impacting our outlook for the U.S. market going for the next 10 years or so.
So I realize every portfolio is different, but if you're telling people to rebalance right now, what would be a general rule of thumb that you would tell them in terms of U.S. equities, international equities, and bonds? How would you kind of split that up?
Well, for the most part, we'd say, look, you want to be globally diversified. We typically encourage folks to try to mimic the market cap of the entire market. So both international as well as domestic and across bonds and equities. So, it's very easy for investors to do that, whether or not they do it actively or on an index basis. But the key thing is that many investors, what happens is they become complacent. And they put these asset allocations in place and they just let them run. But they're not realizing that when you have a big run in the equity markets like the U.S., you ultimately get overweight and your portfolio becomes riskier over time. So, again, just encouraging those investors to continue to rebalance and get back to their more neutral weights, and that they can live through any downturn because their risk isn't too high in their portfolios.